Good morning, everyone. This is KAF here, checking in. It's the beginning of November, November 2nd, and I'm going to be doing this video lesson about short selling. We were talking about this in the chat room a little bit today, and I figured, what the heck, I should make a video on this and answer some questions that people have about short selling and what it is exactly. So let's get started. Let's start off talking about some terminology. You may have heard these words before, someone going long or someone going short. Some new traders may initially think, if I'm going long, that means I'm getting into a long-term position, or if I'm going short, that means I'm getting into a shorter position, as in, maybe 10, 15 minutes. But if you're going long, it's a couple days, a week or so. That's not actually what it means. Going long implies to being bullish on a stock. Now, you've also probably heard bullish or bearish within stock market talk. Bullish means that you believe stocks will be going up. And that's what going long means. You see I have long there in green. And when you're going long on a stock, you're anticipating to buy a stock at a low price and selling it at a high price. That's just stock market 101, how most people have an understanding of that concept and how that works. So that's going long. You buy low and sell high. Now, going short is simply the exact opposite of that. Not only do you sell first and buy second, you're trying to sell high and buy low second. Okay, now this will make a little bit more sense as I give you some examples here. But if you're going short, or if you are bearish on a stock, that means you are betting that these stocks will decrease in price and decrease in value. So it's good to understand those two different types of terminology there. So how does shorting work? Well, when you short a stock, as I mentioned, you are actually selling the stock first. So for an example, let's take a $1 stock. Let's say you want to short a $1 stock because you believe the value of that stock will decrease, say, to 90 cents or so. So what is going to happen, you're going to take that $1 stock, say it's stock A, B, C, D, and you will sell that stock at $1. Your brokerage account is now credited $1. Okay, so you are up $1 on that stock. But the condition of this is that you have to buy the shares back later. Now, some brokerages will have time frames and time limits and whatnot of when you have to buy those shares back. But generally speaking, most people who short things in the shorter term, day trading shorts. Some people will short stocks long term, but generally speaking, it's usually a quicker time frame. So, as I mentioned, if you short a $1 stock, your brokerage account will be credited $1. Now, let's say that stock drops down to 90 cents. You then say, okay, I'm ready to get out of this short position. If it's at 90 cents, you then will buy back your stock at 90 cents. The difference is the 10-cent difference that you just made from shorting that stock. So you have to buy the stock back. Another word for this is covering. People will say covering your short position. That's just kind of a more fancy word to say getting out of your short position or buying your stock back from your initial short or sell. Now, as I mentioned here in the second bullet point, different brokerages have different availabilities on what we call borrows or shares available to short. Borrows is just kind of a fancy word meaning that if I want to go short stock A, B, C, or D, that brokerage has to have the availability to short the stock. Okay, and that gets kind of confusing and can get complex. Different brokerages will communicate with each other, and you can lend shares to short from some brokerages. You can call your broker and have him, call a different broker to see if they have shares, and that kind of gets all kind of messy and confusing. But that is why some brokerages are better to short than others. For example, I use TD Ameritrade, and TD Ameritrade doesn't have the greatest availability of borrows or shares available to short. Now, there are other platforms and brokerages, such as Interactive Brokers, E-Trade, SureTrader, things like that. Some of those different platforms have better availability to short. So if you're looking to be more on the short side of things, it's something to consider which broker has the best borrows or shorts available to short. Now, one thing with shorting is that you have limited profit potential. Now, if I was going long or buying a stock anticipating it to go up, let's go back to stock ABCD that I buy at $1. That stock, as long as it goes up, I'm making profit. So if that stock goes to $1.50, I just made 50 cents profit. If it goes to $2, I make a full dollar profit. If it goes to $10, I just made $9 a share profit, or 1,000% profit. Now, if I'm shorting that $1 stock, the absolute most that I can possibly gain from shorting that stock would be $1. I sold the share at $1, and say for some reason, something happened and went all the way to 0 cents, or I buy that stock back at 1 cent, I made 99 cents of profit there. And so I'm limited on my profit potential there. But on the other hand, your risk is significantly greater when you short. Because if I short a stock at $1 and it goes up to $10, well, I just lost 10 times more than I initially even invested in that stock in the first place. So this is where people can get in some danger. And I'm going to talk about that in here. You actually have the potential to lose more than you initially invested and could end up having to pay back your broker. There are horror stories out there that you can look up of people who were short a stock. They woke up the next day to see the stock was up 500%, 600% on some big breaking news. And now they are in serious debt to their broker. They lose their entire portfolio, and in addition to that, they have to reach into other funds or work out, a debt payback plan with their broker because they now owe their broker significant amounts of money. So if you are interested in shorting, please take serious and extreme precautions to have stop losses in. When you short, and in order to short, you have to have a margin account. A margin account means your broker is basically lending you some money. Your broker will not allow you to short a stock unless you're on a margin account because of the unlimited potential risk with shorting. So some more terminology here. I want to talk about what a short squeeze is. This is important to understand if you're long as well as short. You'll hear people use this term short squeeze a ton, and I'll be honest, I think it's totally overused, but it is a good concept to understand. What a short squeeze is when a stock begins to rise and shorts who are in this stock, they start to say, oh no, this stock is going up. I'm going to begin to cover my position or buy back my position so I can get out, play it safe, take a minimal loss. Well, when that happens, the more the shorts buy to cover stock, the price will continue to rise. And on top of that, longs may be looking at it and say, oh wow, this stock's going up. I like where this is headed. And they're going to get into buying as well. So a short squeeze is when you see a significant price squeeze or price action on a stock, especially a stock that has a high amount of shorts in it. Now, you can potentially look up numbers, what's the short float or what's the short ratio. And basically those numbers try to tell you how many shorts are in a certain stock. So if a stock has a 10% short, a short float, that means that 10% of the shares of that stock are currently shorted. So if a stock, was to start going up and shorts had to squeeze, that means that 10% of all those shares are shorts that are going to have to cover. Now, an SSR is another important thing to understand. It stands for short sell restriction. This is triggered when a stock loses more than 10% of its value. And the reason why this is a thing, I think this was implemented, I'm not even sure. I'd have to check my history. 15, 20 years ago, the SEC implemented this SSR. And what this does is this helps prevent stocks from just getting absolutely destroyed by short sellers. Some person can't come in with $1 million and just say, this stock right here, I'm going to take down to the absolute dirt. And they just short after short and just completely destroy the stock entirely for no reason other than, they just don't like the stock or something like that. Or maybe they do have good reasons. But an SSR is in place to help protect that. So if a stock goes down more than 10% in one day, the following day it'll be on SSR. Now that doesn't mean it cannot be shorted. It still can be shorted, but all it means is that it can only be shorted on an uptick. Now what does that mean? Let's say the stock is trading at $1. Typically, if you wanted to short that, you could just sell the stock into the current bid at $1 and be short $1. Well, now with an SSR, if the bid is at $1 and the ask is at $1.01, you have to put your short sell in at 1 cent, wait for a buyer to come, raise the price to $1.01 and fill your short sell. Does that make sense? I hope it does. I'm trying to be clear about this, and hopefully that makes sense. So you can also, you could even Google SSR, short sell restriction, and potentially get a little bit better explanation on that. So now I want to show you some real life examples here of what I mean with some of this. Here's some real life examples of what I mean. So we're looking at stock BLDP. I'm actually currently in this stock as we speak. I bought this over $5.40. I went long on the stock, meaning I bought low in anticipation that it will go up. And it did. Beautiful, nice breakout over the 540 level, positive earnings day. These plays have been hot. Textbook. In around 540, I'm going to be looking to sell shortly. I want to see if it can make a little bit more of a push here into power hour and end of day. There's a couple hours left in the market. So this is an example of going long on a stock. Okay? You buy low, you sell high. Now, the example I want to use to talk about shorting is MARA. Now, I did not actually short this stock, as TD Ameritrade didn't have shares available. But this stock recently did what we call a reverse split. A very common trading strategy and short strategy is to short stocks that have recently gone through a reverse split. Now, what's a reverse split? Let me show you here. You'll see the stock was trading back here at 25 cents, okay? What they did here is you'll see they have reverse splits here. They took this stock and combined it, and it appears they actually had back-to-back reverse splits. Wow, that's interesting. What they did is they took, for every 4 shares of a stock here at 25 cents, they put them together and now said, okay, this stock, every 4 shares of stock is now only $1. And what that does is, it's only 1 share. What that does is that raises the share price and condenses the amount of shares. So this may look like this made a huge giant spike, but in reality it did not actually. In reality, this is bad news. And so what many people do is they will short recently reverse split stocks, because truth is the majority of stocks that do a reverse split within a couple weeks will tend to lose 30 to maybe even 50% of their value. Now that's not always the case, but that's just a strategy that the short sellers use. And so you want to be careful when going long on stocks that have recently been reverse split. So anyways, let's just say, hypothetically speaking, that I sold short this stock at $2.30. So that means I went in and sold this stock here at $2.30, perhaps even in pre-market. Now, the more the stock goes down, the more that it makes. Let's say I covered my short here at $2. So I sold at $2.30 to short it. I then bought or covered my short at $2. I just made 30 cents a share of profit on shorting this stock. Now maybe, let's say I held even longer, went down to $1.70. I covered there. I just made 60 cents a share of profit. So there are different strategies and different ways to short things. I want to show you an example of a stock which recently squeezed many shorts. This is PYDS. Let me show you here. This is a stock that moved big back on Tuesday, made a big move from $1.35 all the way up to near $3. Okay, that's over a 100% move. Well, many shorts, what they'll do when they see a stock make gigantic moves like that is they will short those, because they say, you know, this isn't going to last, this is just a pump, this is fake news, whatever. And so they will get in and short this. And you'll see initially people who shorted up here in this area and covered potentially over here made some money. But the stock just wouldn't really die. It held its gains actually pretty well. And the longer a stock holds its gain, the more likely there's a chance for what we call a short squeeze. Well, as I went over earlier. Well, this is what we get with that short squeeze. There were a ton of shorts who got in on this huge 100% spike. And there were also all those shorts who got in at this area got squeezed and had to cover for losses on this huge move, creating just this huge parabolic spike up to 410. So this is an example of, you know, people who shorted this at 260 and got squeezed on this. They lost a lot of money on this as a short. So I hope this video is helpful. Please ask me questions in the comment section. Please like this video and subscribe to my channels, and you know, message me or comment on this if you have any other questions. And come start a free trial with us at kafinvesting.com. We'd love to have you join us.